Good day, all. Ira Epstein of Linn & Associates with your metals market wrap-up, and this is for Monday, the 20th of April, 2020, and we're about 3:40 p.m., and that is Central Time. As you can see, gold up $13. Remember, it lost 40 some odd dollars last week, so we're getting a little bit of a bounce. The silver market up 25 cents, good performance. Copper's given up quite a bit. Now, the event of the day wasn't in the metals. It was in the May crude oil, not the Junes and the other months. They were down as it was. But the May did something in my 50 years I've never seen. It went negative in pricing. Started off the day near 20, ended up negative $35 a barrel. And I had several questions. I was asked this morning, can it go negative? I said, I don't know. Can the computers handle it? I don't know. How do you place an order on negative? I didn't know. And it does go negative, and it's finished $35 a barrel minus. So somebody, if you bought a contract, you're going to get paid $35 a barrel, but what are you going to do with it? Contract expires tomorrow. Where are you going to store it? All the storage facilities in America are pretty much called for. In other words, they're all accounted for right now. You're going to rent a vessel every day to put out oil out there that you're going to try to sell? Maybe. I don't know. Can you get the vessel? Another problem. You take delivery. They're going to tell you move your oil right now. We need the area. It's a pros game. You don't belong in it. That's the point. When you're looking at the weekly chart of closes in the gold, you can see the market was down about $47 last week, gave back today, came back $11. Okay, and the market still has an upside bias. It's trading over the 18-week moving average of closes. This is a weekly chart of just closing prices, not highs, not lows. When we go to a bar chart, and this is what most of you used to seeing, you can see how the market's been coming down, and when I put the swing line on it, we have a pattern of lower highs, lower lows. That's a downtrend. So that part of the market's bearish. I filter the swing line by looking at the 18-day average of closes. The market is over that. That part of the market is therefore friendly. The two fight each other and you have nothing. There's more to it, and I'll show you that in a second. Bollinger Bands, which are these black dashed lines, number one, they don't run parallel to anything. They're theoretical resistance and support numbers. That's what they are. The market will trade within them 95% of the time. The reason you don't want 100%, you want to use them when they get hit to say, the market's hit a resistance point. The odds of it staying outside of that band are only 5% of the time. Traders sometimes take money off the table at that point. On the downside, the same thought. The momentum is what's at work in this market. This is a market that had embedded reading. Embedded means the market goes from being overbought. Any numbers, charts that get over 70, I call overbought. So markets can do two things with an overbought. They can correct it by typically dropping in price, or they can go on to lock in a trend called embedding. Embedding occurs when both the numbers that make it up go over 80 for several days in a row. With that, you're typically looking for higher prices to develop. When the red line closes back under 80, all fear should hit you, because now suddenly the momentum is changing, and one of the things that I teach is momentum often leads price. So now you lose the embedded reading and market's making its run back to the 18-day average of closes, that line in the sand to try to figure out what to do next. In the gold-silver ratio, during this part where the market was staying over the red line, gold was accelerating in value against silver. When the market gets under that number, gold is losing that acceleration and silver is gaining in value against gold. So it's another line in the sand, the way to look at this. When I look at silver, I don't have a trend. I have a higher high and a lower low. Here too, we had an embedded reading that was lost. And when the market loses the embedded reading and doesn't get it back instantly, the odds favor price and the 18-day average are going to make a run at each other, and you're trying to make that run in a way right now. I don't think it's completed it. Often you hit the 18-day average. This isn't what I call hitting the 18-day average. Not close enough. In the copper market, if we look at the numbers here, both numbers are over 80 today. They were both over 80 on Friday. They were not the day before or the day before. So this is just an overbought market. It could, tomorrow, with another settlement, we're both over 80, embed, lock in an uptrend, switching the market to the pros, buying the breaks until that is lost. Right now they're doing that anyways. They have the higher lows, higher highs at work, and I think they're pumping out against the Bollinger Band. 95% of the time the market will trade within it. That's what I think they're doing. In the platinum market, you lost your bullish embedded reading. I think the pros are going short this market with stops over the highs right up here, looking to see if they can drive it back down to 750, 260. The reason short is because there's enough room in there for them to play. It's still a pretty big risk from 785 all the way up here to the 830 or 40 level, but that's what I think they're doing. And in the palladium market, I just see total sideways action that we've been doing against this 100-day average. Always plot key averages. You get a feel for what the market's zoning in on. And it's not the 18-day, it's the 100-day. As that's occurred, if we look at what the Bollinger Bands are doing, these black lines, look at how they're coming in at you. And that means volatility has come out of the market, and you start hitting these bands trying breakouts on either side, and it's often full of whipsaws, just something to keep in the back of your mind. In the dollar index, you're hugging this 18-day average of closes now. So which way do we get a breakout? Temporarily, we have lower highs. That's the legacy. But with today's close up here, we also have higher lows. So if you get over 139, you break the pattern of lower highs and higher lows to one of higher lows, higher highs, putting into play wherever the Bollinger Band is. And I ran the numbers. It's falling about 50 points a day. That means it's going to be right on top of current prices. If you break out to the downside, the market at 99.66, and don't get up and over that number, you'd have lower highs, lower lows, reinserting the bear trend under the 18-day average, setting up the potential to make a run at the lower Bollinger Band, and that's moving upward the past few days about 40 points a day. So that would be around the 98, 90 level. Momentum has been pointing gradually up, and you can see prices have moved with that momentum to the upside. A tool I use intraday to get a feel, like in the dollar index, who's controlling the flow during the day, are pivot points. What a pivot point looks at is the previous day's range. There's a formula. And you're developing resistance and support levels with the formula. We teach you how that works. You don't have to do the formula. Most charting services do it for you. It then plots it, and I teach you the colors I'd want you to have on your charts and so on, and how to work with this. And then I tie momentum into it. So I'm looking at resistance points. Where might the pros be selling? The support points where they're coming in. And is the market getting overbought or oversold on intraday charts? Most traders use a 15-minute chart on that. How do you get all this information and learn it? Simple. Go to our website, sign up for our free offer. You'll see this in there as the video series. We'll get it right to you. You can click up here if you're watching me on YouTube. We'll send it that way as well. I'm Ira Epstein. You have a good day, and I will talk to you all tomorrow. Take care now.